In this presentation, we will take a look at Qualified Tuition Program, or QTP. This will be a long presentation, so if you would like to jump to relevant components within it, take a look at the description below where we will have links to those components as well as a description of what those components will contain. We'll discuss what the Qualified Tuition Program is, the tax benefits of the Qualified Tuition Program, we'll give some examples of the Qualified Tuition Program, and much, much more. In this presentation, we will take a look at an introduction to Qualified Tuition Programs, or QTP. This information can be found in Publication 970. Introduction. Qualified Tuition Programs, or QTPs, are also called 529 plans. So if you hear QTPs or 529 plans referring to the code, the IRS code section, these are the same thing. States may establish and maintain programs that allow you to either prepay or contribute to an account for paying a student's qualified education expenses at a post-secondary institution. So we have the post-secondary institution. Eligible educational institutions may establish and maintain programs that allow you to prepay a student's qualified education expenses. So we may have the ability there then to prepay for the student's expenses, and that could give us some benefits to be able to prepay them with regards to our taxes. Continuing on, if you prepay tuition, the student's designated beneficiary will be entitled to a waiver or a payment of qualified education expenses. You can't deduct either payments or contributions to a QTP. In this presentation, we will introduce Qualified Tuition Programs, or QTP. This information can be found in Publication 970. Introduction. Qualified Tuition Programs, QTPs, are also called 529 plans. So 529 referring to the code sections, QTPs, same thing, Qualified Tuition Programs. States may establish and maintain programs that allow you to either prepay, so we can either prepay or contribute to an account for paying a student's qualified education expenses. So that's probably the more common thought process, that we would put money into an account that would be established with regard to a QTP type of account that then can be used for a student's qualified education expenses, possibly expenses in the future. Back to the text. At a post-secondary institution. Eligible educational institutions, so that's going to be a key term, of course. What is an eligible educational institutions? May establish and maintain programs that allow you to prepay, so we have prepay, a student's qualified education expenses. So we could have an institution that actually allows us that prepayment ability. If you prepay tuition, the student designated beneficiary, so of course this prepayment is for a student, which would be the designated beneficiary, will be entitled to a waiver or a payment of qualified education expenses. You don't deduct either payments or contributions. So notice the goal here isn't to have a deduction on the front end. In other words, when we put the money into the QTP, we're not looking to do so in order to get the deduction on the front end. That's not what we're going to get. Unlike, say, if you're thinking about something like an IRA or something like that, we would put the money in to the account and hopefully get the deduction on the front end. Here, that's not the case. We're going to put the money into the QTP. The benefit will typically be when the money comes out of the QTP, because then it shouldn't be taxed at that point in time. If there's any growth on it, then it shouldn't be taxed at that future time. That's going to be the benefit. So either payments or contributions to the QTP. For information on a specific QTP, you will need to contact the state agency or eligible educational institution that establishes and maintains it. So notice we're going to the state agencies or the actual institution to get the information about the specific QTPs. Tip. This benefit applies not only to higher education expenses, but also to elementary and secondary education expenses. What is the benefit of the QTP, you may ask? No tax is due on the distribution from the QTP unless the amount distributed is greater than the beneficiary's adjusted qualified education expenses. So the benefit doesn't happen at the point in time we put the money into the QTP in the form of a deduction. That's not where the benefit happens. The benefit happens as time passes and the value of the QTP contribution increases in one form or another, hopefully. And then when the money is used for the qualified education, there's no tax at that point in time as it's drawn out. Again, you might say, well, why would it be taxed? Because it's my, I put money in. Why would it be taxed? Because the value of it could have increased, and typically the increase in the value is the thing that could be taxed as income. And that's what could be the benefit. So that's our goal. So see our distributions taxable later for more information. Obviously, in order for it to be a benefit, then it has to meet the goal. And that means that it's got to be paid for the qualified education expenses, which we'll need to make sure that we defined and are in accordance with as we make the payments out of the QTP. Tip: even if a QTP is used to finance a student's education, the student or the student's parents still may be eligible to claim the American Opportunity Credit or Lifetime Learning Credit. So you might be thinking, there's so many educational benefits, they kind of overlap. We have some issues with it. And one of the big ones is the credits that could be there, American Opportunity Credit and the Lifetime Learning Credit. So you might say, well, what if I have money in a QTP and then they go to school and the money comes out of the QTP? Well, that's great. But what about these credits that could have a huge benefit at that point in time? Do I lose the credits because we took money out of a QTP to pay for the education? Well, not necessarily. You can look at coordinations with the credits that will be there as well. And in essence, you'll see how they kind of get put together. In essence, they could be, the expenses will probably be greater than, if we're going to many types of schools or institutions, greater than the amount that comes out of the QTP at that point in time. And in that case, the expenses that aren't applied to the QTP, or in other words, aren't paid with the QTP, are probably eligible or may be eligible, or we'll go into more detail about it, for other benefits, including possibly the American Opportunity or Lifetime Learning Credit. Again, that's just a brief overview, but you might want to consider and think about, well, how does the QTP relate to the types of credits that are currently available? And remember, the credits, of course, could change in the future, and the law could change at some point in time. But as of now, how does it work at the point in time when the expenses would be incurred in terms of the money coming out of the QTP, and then the other benefits, the huge benefits that could be there with relation to the credits for education. And we can look at the coordination of those items in future presentations. In this presentation, we will take a look at the question of what is a qualified tuition program, a QTP. This information can be found in publication 970. What is a qualified tuition program? A qualified tuition program is a program set up to allow you to either prepay or contribute to an account established for paying a student's qualified education expenses. So of course, we're imagining here we have a student, possibly a child, going to school in the future, and we want to put money that will be set aside for the qualified education expenses. You might say, well, why don't I just put that into some type of savings account or some type of investment account that will then grow for that particular student? Well, of course, we're looking for some tax benefits within that as well. Back to the text. At an eligible educational institution, another key term here, eligible educational institution, QTPs can be established and maintained by states or agencies or instrumentalities of a state and eligible educational institutions. The program must meet certain requirements. Your state government or the eligible educational institution in which you are interested can tell you whether or not they participate in the QTP. Qualified education expenses. So that's one of our key terms. What does it mean to be a qualified education expense? So note what we're considering here. Putting money into a QTP plan, that money then being used at some point in the future, taken out of the QTP plan, not being taxed at the point that it's taken out of the QTP plan is the goal, not a deduction as we put into the QTP plan. The benefit being that the value of the QTP plan is not subject to tax if that is the case. So then when we pull the money out of the QTP plan, what does it need to be spent on? It needs to be spent on the qualified education expenses for the beneficiary. What does it mean to be a qualified education expense? Here we go. Generally, these are expenses required for the enrollment or attendance of the designated beneficiary at an eligible educational institution. For purposes of QTPs, the expenses can be either qualified higher education expenses or qualified elementary and secondary education expenses. And now we'll get into the designated beneficiary. So what is a designated beneficiary? The designated beneficiary is generally the student or future student. So of course that's the person that we're putting the money into the QTP for their qualified education expenses sometime in the future. Back to the text. For whom the QTP is intended to provide benefits. The designated beneficiary can be changed after participation in the QTP begins. If a state or local government or certain tax-exempt organizations purchase an interest in a QTP as part of a scholarship program, the designated beneficiary is the person who receives the interest as a scholarship. Eligible educational institution. So what does that mean? What is an eligible educational institution? We've seen that key term a few times. The QTP needing to be set up in relation to one generally. So here we go into what is an eligible educational institution for purposes of the QTP. For purposes of a QTP, an eligible educational institution can be either an eligible post-secondary school or an eligible elementary or secondary school. Eligible post-secondary school defined, so we'll go into the definition of an eligible post-secondary school. An eligible post-secondary school is generally any accredited, public, nonprofit, or proprietary, privately owned, profit-making college, university, vocational school, or other post-secondary educational institution. Also, the institution must be eligible to participate in a student aid program administered by the U.S. Department of Education. Virtually all accredited post-secondary institutions meet the definition. So key term here, virtually all accredited post-secondary institutions. So you want to basically go to the institution, you want to see that they are accredited. If they are, virtually all of the institutions meet this definition, but then of course you want to contact the institution and just verify that that is the case. The educational institution should be able to tell you if it's eligible educational institution. And eligible educational institution also includes certain educational institutions located outside the United States that are eligible to participate in a student aid program administered by the U.S. Department of Education. Eligible elementary or secondary school. So we've mentioned the eligible elementary or secondary school. Here's the definition. An eligible elementary or secondary school is any public, private, or religious school that provides elementary or secondary education, kindergarten through grade 12, as determined under state law. Qualified higher education expenses. What are the qualified higher education expenses? What do we need to be paying this money for at the end of the process in order for the money being drawn out of the QTP to be tax-free? Or that's one of the goals. So what's the definition of qualified higher education expenses? These are expenses related to enrollment or attendance at an eligible post-secondary school. As shown in the following list, to be qualified, some of the expenses must be required by the school and some must be incurred by students who are enrolled at least half time, defined later. So note, when we think about these qualified higher education expenses, you got to be careful, because when we think about the education expenses, we need to make sure that we're looking at these terminologies with regard to the correct benefit program that we're looking at here. So as you look up the terminology, what does it mean to be qualified higher education expense? Make sure that you're looking at that definition as it relates to whatever it is you're thinking about, which in this case is a QTP plan. So here we go. Number 1, the following expenses must be required for enrollment or attendance of a designated beneficiary at an eligible post-secondary institution. That's going to be tuition and fees. Notice, of course, the tuition and fees is what we would consider. So if we put money into the QTP, we would expect, of course, the tuition and fees to be something that would be qualified education expenses. And then, of course, you might be getting more creative than that, right? Then you might be thinking, well, what else could qualify as a qualified education expense that I can then take this money and possibly put it somewhere where it can grow and have some benefit that might be tax-free? Well, the tuition and fees, if we take the money out and everything's fine, then of course the tuition and fees you would think qualify for higher education expenses. B, books, supplies, and equipment. So that would be somewhat, we would think that's pretty standard. The books, you would think that would be qualified, fairly straightforward. Number 2, expenses for special needs services needed by a special needs beneficiary must be incurred in connection with enrollment or attendance at an eligible post-secondary school. So that's a special needs kind of exception there. 3, expenses for room and board must be incurred by students who are enrolled at least half time. So we got one of the ones that's a little bit more room and board, that's one of those ones that we might think isn't just a given as far as the tuition, of course. So we have the room and board here. So expenses for room and board must be incurred by students who are enrolled at least half-time. So now we have this definition of half-time. They would have to meet that in order to possibly have the room and board qualify. The expenses for room and board qualifies only to the extent that it isn't more than the greater of the following two amounts. So restrictions on the home and board: A, the allowance for room and board as determined by the school that was included in the cost of attendance for federal financial aid purposes for a particular academic period and living arrangement of the student. B, the actual amount charged if the student is residing in housing owned or operated by the school. You may need to contact the eligible educational institution for qualified room and board costs. So again, this would probably be something that the institution is where you want to start out to know what the qualified costs would be with relation to the room and board. Number 4, the purchase of computer or peripheral equipment, computer software, internet access, and related services if it's to be used primarily by the beneficiary during any of the years the beneficiary is enrolled at an eligible post-secondary school. So again, this is another one where you might say it's not like a given. We would think that tuition would be given. Now we're talking about types of equipment. So the purchase of computer or peripheral equipment, computer software, and internet access. So those are some items to consider. Back to the text. This doesn't include expenses for computer software for sports, games, or hobbies unless the software is predominantly educational in nature. Half-time student. So now we have this term of half-time student for the room and board. What does it mean to be a half-time student with regards to the room and board, with regards to the QTP? A student is enrolled at least half-time if he or she is enrolled for at least half the full-time academic workload for the course of study the student is pursuing as determined under the standards of the school where the student is enrolled. So again, you got to basically go to the school because the school's going to have their own semester units or credit units or quarter units or whatever they call them. And they're going to have to tell you what it means to be full-time and what it means to be half-time, and they should have that down because it's going to be in accordance with their system. So they should be able to tell you and provide you with the information as to what it means to be full-time, what it means to be half-time with whatever units of measure that they use. Back to the text. Qualified elementary and secondary education expenses. These are expenses so now we're thinking about not the post-secondary or not the college. Now we're thinking about the qualified elementary and secondary education. So these are expenses for no more than $10,000 of tuition incurred by a designated beneficiary in connection with enrollment or attendance at an eligible elementary or secondary school. In this presentation, we will discuss how much you can contribute to a qualified tuition program, a QTP. This information can be found in publication 970. How much can you contribute? Contributions to a QTP on behalf of any beneficiary can't be more than the amount necessary to provide for the qualified education expenses of the beneficiary. There are no income restrictions on the individual contributors. So this is going to be really nice. There's no income restrictions on the contributors. So whatever our AGI, we don't have that kind of AGI type limitation we may see in other types of benefits. And then the amount that we can put into the QTP is not restricted either, other than by the amount that would be necessary for the beneficiary's qualified education expenses. So if we're imagining putting money into the QTP, obviously, we don't have that AGI type limitation when we put it into the QTP, and we don't have the same kind of dollar limitation in terms of the restrictions of it. But of course, at the point in time that that money will be used for the qualified higher education, we can't have more in there than it's going to be used for the qualified higher education because, of course, there's not going to be any tax benefit at that point in time. In other words, the point of it is to be able to put it into the QTP plan so it can be used in any accumulation in value not to be taxed. That's the tax benefit until it's pulled out of the QTP plan. When it's pulled out of the QTP plan, then that's the point in time that we're hoping it's not taxed at that point in time. And for that to be the case, of course, it has to be spent for its objective, which is the qualified education expenses for the beneficiary. Back to the text. you can contribute to both a QTP and a Coverdale ESA in the same year for the same designated beneficiary. So this is nice that these two kind of work together. We've got the QTP plan and the Coverdale ESA, two types of contribution plans that could give us tax benefits, and those two we can contribute in them for the same beneficiary. Recontribution of refunded amounts. If a student receives a refund of qualified education expenses that were treated as paid by a QTP distribution, the student can recontribute these amounts into any QTP for which they are the beneficiary within 60 days after the date of the refund to avoid any need to future taxable part of the QTP distribution. So in other words, we can imagine basically a situation where we're going, the beneficiary is going to school, they put the money, take the money out of the QTP, they put it into the education expenses, and then they get a refund of those expenses for whatever reason. Maybe they didn't complete the course or something like that, or they dropped out before the date, got a refund of the expenses. Well, now you got the money back because it was a refund. If they put the money into the QTP within 60 days after the date of the refund, they could put it back in the QTP and avoid the need to figure the taxable part of the distribution for that refunded amount. In this presentation, we will discuss the question of, are distributions taxable with relation to qualified tuition programs, QTPs? This information can be found in Publication 970. Are distributions taxable? The part of a distribution representing the amount paid or contributed to a QTP doesn't have to be included in income. This is a return of the investment in the plan. So in other words, when we think about the QTP plan, we're thinking about, all right, we're putting money in today, possibly we're thinking today, and then later on, there's going to be qualified tuition expenses that hopefully will be paid for. That's when the money is going to come out of the plan. We're not getting any benefit as we put the money in the plan today. We're not getting a tax deduction for it. Why do it then? Why not just earmark some kind of savings account or investment account for education? We want some tax benefit. What's the tax benefit? Not a deduction at the point of contribution, but the growth in the funds will not be taxed when it's taken out if used for qualified education purposes. So that being the case, then there shouldn't be any kind of situation where the actual investment, the amount that we put in, should be subject to taxes in any kind of situation, even if it wasn't used for qualified tuition purposes, because that's just our original investment. That we didn't get any tax benefit from that. So the tax benefit shouldn't be on the original investment or any kind of penalties or any kind of tax. It should be on the growth of the account as it was distributed. So first thing we want to establish then is, upon distribution, even if it wasn't used for qualified tuition purposes and it didn't meet its objective, we still shouldn't be taxed on the original investment, because that's just the original investment. The amount that could be subject to taxes and whatnot would be the growth at that point in time. So back to the text. The designated beneficiary generally doesn't have to include in income any earnings distributed from a QTP if the total distribution is less or equal to adjusted qualified education expenses. So that's, of course, the goal. So the amount that we originally put in there shouldn't be subject to any kind of taxes, because that's the original investment. The amount, and then any amount, including the original investment or any growth in it, shouldn't be subject to taxation either if it's used in accordance with the objective of the QTP, which is being taken out for the adjusted qualified education expenses. So as long as it was taken out in order to pay the adjusted qualified education expenses, in other words, as long as the adjusted qualified education expenses are greater than the amount taken out of the QTP plan, then it should be good, and we shouldn't have to include anything in income. It should be straightforward. We don't have to include it on the 1040 in any way in income and whatnot, and therefore not be paying taxes on it. So then we have the definition under figuring the tax portion of a distribution in a later part. Earnings and return of investment. You will receive a Form 1099-Q from each of the programs for which you receive a QTP distribution in 2018. So that's going to be, of course, our tax form, our 1099-Q. The amount of your gross distribution, box 1, shown on each form will be divided between your earnings, box 2, and your basis or return of investment, box 3. So they're going to give us the total distribution and then obviously the breakout of the basis and the amount of the return on the investment with the form that we should be getting for our taxes, of course, the 1099-Q. Form 1099-Q should be sent to you by January 31st. So at the end of the tax year, it should be in the first month following the end of the tax year. If you don't get it by that time and you have questions about it, contact whoever you got to contact that's dealing with your QTP plan about it. Figuring the taxable portion of a distribution. To determine if total distributions for the year are more or less than the amount of qualified education expenses, you must compare the total of all QTP distributions for the tax year to the adjusted qualified education expenses. Adjusted qualified education expenses. So now we got to say, well, what does it mean to be an adjusted qualified education expenses? Because I have to make sure that I have enough qualified adjusted qualified education expenses higher than the amount that was distributed from the QTP so that I don't have to deal with any kind of tax consequences. Okay, so now what does it mean to be an adjusted qualified education expense? To the text. This amount is the total qualified education expenses reduced by any tax-free educational institution. Tax-free educational assistance includes. So we've got the qualified education expenses that we talked about. What does it mean to be a qualified educational expense? And then we're going to have to reduce it by certain items, including those things that might have been tax-free. We paid for the tuition, the qualified education expenses with tax-free money. Things like a tuition, like a scholarship or something like that, we would have to reduce. So that would include tax-free part of scholarship and fellowship grants. So if we paid, our education expenses with grants partially, then we can't like double count that. We can't count it towards our QTP payments as well, because we already paid it with tax-free money that we didn't have to include in income. So we'd have to reduce the adjusted qualified education expenses by the scholarships and the free grants. The Veterans Education Assistance, same kind of concept. The tax-free part of a Pell Grant, same kind of concept. And then employer-provided educational assistance, same kind of concept. Any other non-taxable tax-free payments received as educational assistance. So again, anything that we paid for our education that was tax-free, we can't really count as part of the adjusted qualified education expenses to be able to take the money out of our QTP without being subject possibly to partial taxation in it. Back to the text. Taxable earnings. Use the following steps to figure the taxable part. So here's how this is. If we have to figure the taxable part, this is the steps that we would go through to do so. Multiply the total distribution earnings shown on Form 1099-Q, Box 2, by a fraction. The numerator, top part, is the adjusted qualified education expenses paid during the year, and the denominator, the bottom part, is the total amount distributed during the year. Number 2, subtract the amount figured in 1 from the total distributed earnings. The result is the amount the beneficiary must include in income. Report it in Schedule 1, Form 1040, or Form 1040-NR, line 21. So here's an example. In 2010, Sarah Clark's parents opened a savings account for her with a QTP maintained by their state government. Over the years, they contributed $18,000 to the account. Total balance in the account was $27,000 on the date the distribution was made. In the summer of 2018, so you can see they put in 18 and it's at 27. So of course it went up in value. That's great. So now they have 27,000, and the difference between the 27 and the 18 is basically gain that hopefully is tax-free if it's being used for the purpose of the QTP, qualified education expenses. Back to the text. In the summer of 2018, Sarah enrolled in college, had $8,300 of qualified education expenses for the rest of the year. She paid her college expenses from the following sources. So now we've got these expenses, and you would think that those are her enrollment expenses for the qualified student. And we would think, okay, well, now we got to figure out if any distribution from this $27,000, as long as the distribution was less than the adjusted qualifying education expenses. These are the education expenses, but not adjusted. So now we have to think, well, how are we going to adjust it? Well, the gifts from the parents. So part of it was paid from the parents, $1,600 of this $8,300. Partial tuition scholarship, so $3,100 was like tax-free money. And then we have the QTP distribution of $5,300. So that's how it was paid. So before Sarah can determine the taxable part of her QTP distribution, she can reduce her total qualified education expenses by any tax-free educational assistance. So of these items, if we look at these, the tax-free educational assistance is, of course, the partial tuition, the scholarship. This was tax-free. So that was money that, so we have to reduce the amount of expenses by that $3,100 to see if our adjusted qualified education expenses are greater than the amount of the distribution, which was $5,300. So then if we think about that, so here's the $8,300 minus the $3,100, which was for the scholarship, leaving $5,200. So now we have the $5,200 left. And since the remaining expenses, $5,200, are less than the QTP distribution, part of the earnings will be taxable. So in other words, we saw the QTP distribution was the amount of $5,300. So $5,300 came out of the QTP, and the qualified was only $5,200. So now we have $100 that would have to be possibly subject to partial taxation. Since the remaining expenses, $5,200, are less, we already saw that, Sarah's Form 1099-Q shows that $950 of the QTP distribution is earnings. Sarah figures the taxable part of the distributed earnings as follows. So here's the computation we'd have to go through. We'd say that the $950 is earnings. So this is the part that's not the return of the original investment, but the earnings on it. So these would be the only ones that would possibly be subject, you would think, to any kind of taxation, and only subject if they were, if there was some kind of issue that we didn't pay the qualified education expenses. There was this issue we didn't pay, and that's what we have here. So we're going to figure the 950 times the 5,200, which is the AQEE, over the 5,300 that was actually distributed. So then we're going to take, that gives us the 932. These are going to be the tax-free earnings. This is the amount of earnings that aren't taxed. And therefore, part 2, we'll take the 950, the total earnings, minus the 932, the tax-free portion, and we have the tax of the $18 taxable earnings. So Sarah must include $18 in income on Schedule 1, Form 1040, line 21, as distributed from QTP earnings not used for adjusted qualified education expenses. In this presentation, we will talk about the coordination of the qualified tuition programs, the QTPs, with the American Opportunity and Lifetime Learning Credits. In other words, when we think about all these type of educational benefits, we're talking about the QTPs. We're concentrated on the qualified tuition programs in this case. How do they play along with the other types of educational benefits, including the types of credits that may be available, which include the American Opportunity Credit and Lifetime Learning Credit? In other words, at the point of distribution from the QTP, when we're paying for the actual tuition and the educational expenses for the beneficiary may also be at that time able to take advantage of credits, which could be very advantageous, which include the American Opportunity and Lifetime Learning Credit. How does the qualified tuition program at that point in time play along with those credits? This information can be found in publication 970. Coordination with the American Opportunity Credit and Lifetime Learning Credits. An American Opportunity or Lifetime Learning Credit education credit can be claimed in the same year the beneficiary takes a tax-free distribution from a QTP, as long as the same expenses aren't used for both benefits. So that's basically the main goal of it. We can't use the same expenses can't be used for both benefits. Now the credits are a huge benefit, so what that means, and we'll take a look at some examples on this, is that normally when we think about the education, especially these days, it's quite expensive. So we may have a lot of qualified education expenses and enough to basically max out possibly the benefits of both the credit and the distributions from the QTP plans. So that may be possible just given the amount of qualified education expenses. The idea then being that we can't use the same education expenses to qualify for both the QTP and the other education benefits, including the credits, the American Opportunity and Lifetime Learning Credit. We'll take a look at an example. Back to the text. This means that after the beneficiary reduces qualified education expenses by tax-free educational assistance, he or she must further reduce them by expenses taken into account in determining the credit. So here's an example. Assume the same facts as example 1. And we saw this in a prior presentation where Sarah had some expenses, and she had to reduce the qualified education expenses by the amount that was that was paid for by tax-free tuition. So if she got something like a scholarship, tax-free benefits, like a scholarship, we had to reduce the expenses by that. Now we have the added information of the American Opportunity Credit. So back to the text. Except that Sarah's parents claimed the American Opportunity Credit of $2,500 based on $4,000 of expenses. So if we take a look at this, it's based on $4,000 of the expenses. So what we're going to have to do is take the qualified education expenses that would be there, and then the $4,000 is being used. $4,000 of those expenses are in essence being used because the $4,000 is what is needed to max out the American Opportunity Credit at a $2,500 credit. And that's the first thing we typically want to do oftentimes, because the $2,500 is a dollar for dollar credit back. So if we can get that credit of $2,500 and we have a choice, then typically that's where we first want to apply any eligible education expenses. So we have that, but now we had to apply $4,000 of those expenses out to get that $2,500 of credit. Back to the text. So the total qualified education expenses were $8,300 minus the tax-free educational assistance. This was like a scholarship or something like that we had to take out. And that gives us the expenses. And the reason, of course, again, that has to be taken out because the money that we got was tax-free. So it was tax-free money. So since it was tax-free, we can't, and we used it to pay the expenses, we already kind of got a benefit from it. So we have to take that out of the qualified education expenses. So that gives us the expenses taken into account in figuring the American Opportunity Credit. So the $8,300 minus the $3,100 minus the expenses taken into account for the American Opportunity, that's this $4,000. So we used up another $4,000 of this $8,300 because we wanted to take that American Opportunity Credit, which is great. And that leaves us with only $1,200 that we can now apply to the adjusted qualified education expenses, or the AQEE, with relation to our QTP plan. So now we have to look at the amount of distributions we got from the QTP plan, and they have to be less than the 1,200. Anything that's over the 1,200 may be subject to taxes then. So then if we say the taxable part of the distribution is figured as follows. So we say that this 950 was in earnings that was distributed from the QTP plan. So we'll take in that and we're going to multiply that. And notice, so the idea here is that the QTP plan, the amount of distributions from the QTP plan were greater than this 1,200. So now we had to basically go in and figure the tax on it because the distribution was greater than this 1,200, which is the adjusted qualified education expenses. To do that, we're going to take the 950 of earnings, multiply that times the 1,200, which is the AQEE, divided by the 5,300. This is the amount that was distributed, right? The 5,300 was actually distributed, and we only had 1,200 of adjusted qualified education expenses, which led to us having to pay basically taxes on part of it. So this is the calculation for that. That gives us a 215 tax-free earnings. And then if we take the 950 minus the 250, that means that we have 735 that are taxable earnings. So that means that Sarah must include 735 in Income Schedule 1 Form 1040 line 21. This represents distribution earnings not used for adjusted qualified education expenses, but still looking pretty good because still got some benefit from it, and of course got a huge benefit from the American Opportunity Credit, which would be a bigger benefit than not including in income. So we got this 2,500 credit. So when you start to combine these things, the credits and the QTP distribution can get a little bit complex. But note that the goal is to basically usually to max out the credit first if possible, and then see the added benefit from the tax-free scholarships. Of course, those are going to be more, typically more beneficial because it's tax-free money. And then the amount that's going to go from these accounts is only the portion that was increased in value is the tax-free portion. So when we take it in order, then we typically have to reduce the scholarship, reduce the amount that goes towards the credit, and then see what's left over if we can still get the benefit from the distribution from these plans. In this presentation, we will take a look at rollovers and other transfers as they relate to qualified tuition programs QTP. This information can be found in publication 970. Rollovers and other transfers. Assets can be rolled over or transferred from one QTP to another. In addition, the designated beneficiary can be changed without transferring accounts. So it's possible to take the accounts from one tax beneficiary account, the QTP account, and put it into another QTP account. And it's also possible then for the beneficiary in some cases to be changed, and that might make it easier rather than rolling from one account to another. Possibly the need would be to change the beneficiary of the one QTP account. So rollovers. Any amount distributed from a QTP isn't taxable if it's rolled over to either another QTP for the benefit of the same beneficiary or for the benefit of a member of the beneficiary's family, including the beneficiary's spouse, or an ABLE account for the benefit of the same beneficiary or for the benefit of a member of the beneficiary's family, including the beneficiary's spouse. But this doesn't include to the extent the amount distributed when added to other amounts contributed to the ABLE account exceeds the annual contribution limit. For more information about ABLE accounts, see publication 907. You can find that on the IRS website. So if you go to the IRS website at irs.gov, take a look at publication or PUB Pub 907, tax highlights for persons with disabilities. Caution: you should contact the qualified ABLE program before contributing any funds to the ABLE account to ensure that the contribution limit will not be exceeded. An amount is rolled over if it's paid to an ABLE account or another QTP within 60 days after the date of the distribution. Don't report qualified rollovers, those that meet the above criteria, anywhere on Form 1040 or 1040-NR. These aren't taxable distributions. So when we consider the rollover, note that, of course, it's going from one taxable or tax-free or tax benefit type of account to another. And therefore, the difference between a rollover is it's not a distribution or is not treated in the same format as a distribution, and therefore shouldn't be necessary to apply it to the qualified education expenses, and not be necessary or have a need to report it on the taxes on the Form 1040. Members of the beneficiary's family. For these purposes, the beneficiary's family includes the beneficiary's spouse and the following other relatives of the beneficiary. So I won't go through all of these. Just note that as you consider the beneficiary's family, just remember that when you consider different parts of the code, the members of the family could possibly differ. So you want to make sure that as you consider the beneficiary's family, that you consider it with regard to the benefit that you're thinking of, and this regard the rollovers related to the QTP plans. Example: when Aaron graduated from college last year, he had $5,000 left in the QTP plan. He wants to give this money to his younger brother, who was in junior high school. In order to avoid paying tax on the distribution of the amount remaining in his account, Aaron contributed the same amount to his brother's QTP within 60 days of the distribution. So in that case, basically there's more money left over. He went to college, $5,000 left over in the QTP account, distributed to Aaron. Aaron then takes that money, rolls it over into another account for a relative, a brother, within the time period of 60 days, qualifying for a rollover rather than a distribution, which then could be subject to tax if not rolled over because there's no more qualified education expenses for Aaron. And therefore, in order to keep that distribution tax-free, putting it back into a QTP, not for him, but for the brother relative within the days needed, the 60-day time period. Caution: if the rollover is to another QTP for the same beneficiary, only one rollover is allowed within 12 months of the previous transfer to any QTP for that designated beneficiary. Changing the designated beneficiary. There are no income tax consequences if the designated beneficiary of an account is changed to another member of the beneficiary's family. So if we look at that same example, assume the same situation as in the last example. Instead of closing the QTP, however, instead of closing the QTP and getting the money, back to text, and paying the distribution into the brother's QTP, Aaron could have instructed the trustee of his account to simply change the name of the beneficiary on his account to that of his brother. So he could have said, hey, don't give me the $5,000 and then I'll put it into my brother's QTP. Would you just take the QTP that is allocated to me, for which I have no more benefit because I have no more education, the $5,000 that's currently in it, keep it in there, just change the name of the recipient from me, Aaron, if I'm imagining being Aaron, to my brother, and then in that way you don't have to do the rollover, because of course now the beneficiary has just changed.